everyone. Thank you so much for joining. Very short video. We discussed how to calculate free cash flows. I did a few videos on cost of capital calculations, and most of you are familiar with the process of calculating and basically making investment decisions. However, there are a few principles that you need to be aware of. And the three key ones, which will actually improve your decision-making process, is following those principles. The first one, use after-tax cash flows. You should evaluate capital allocation decisions based on after-tax cash flows and not on profit or accounting-based measures. Yeah, we talked earlier about formulas, free cash flow to equity holders, free cash flow to the firm. These are all after-tax measures. We are not using accounting-based measures. Yeah, it's really important that you reflect the impact of taxation on a project, and especially the tax benefits derived from non-cash deductions such as depreciation, amortization. So really important after-tax cash flows. Second, incremental cash flows only. Yeah, capital allocation should ignore sunk cost. What are sunk costs? Sunk costs are expenses that have already been incurred in the past, that have no impact on the future. Yeah, everything we do in finance, especially valuation, is forward-looking. Yeah. Also, incremental only incremental cash flows associated with, for example, a new project, new investment, as compared to without it. Yeah, you need to ensure that you don't pull in the impact from other projects or expenses or revenue from the firm without the projects. Yeah, it's really important also to think about, do you have other indirect effects? If you invest in a project, does it have some cannibalization? Does it have a positive or negative effect on other projects? Those things are to be included. Yeah, a positive effect might include cost savings with business activities that directly result from making the investment, and a negative effect might be the loss of sales from a similar product like cannibalization. Yeah, both are incremental cash flows and needs to be included in the analysis. Last one, really important, and you know this because time value of money and how we discount our cash flows, the forecasted timing, duration, volatility, and change in the possible direction of expected cash must be considered, because you know NPV and IRR change a lot when cash flows are moved one period earlier or to a period later. Yeah, so really important. After-tax cash flows, incremental cash flows only, and timing of cash flows are key. Thanks so much for listening. I see you in another video. Bye-bye.